Welcome to Quiver Financial's weekly market report. It is July 11th, and it's been 2 weeks since our last report. So this week, I'm going to do something a little bit different because normally we talk about the news that's been happening and how it's affecting your portfolio. We update our Quiver clients on the moves that we've been making in the portfolios. Since it's the middle of the year, we just got through June, starting July. We're after July 4th. I hope everybody had a great time on the 4th of July. We had great weather here in California. And so, what I'm going to do today is I'm going to give all the Quiver clients and anybody else who's interested in it a mid-year update on our 2025 investment themes. And as you all know, who've been following the show for a while, or our Quiver clients, we start every year with some investment themes. One of those themes that we had today, when we started in January, that I'm going to update you on today, is around interest rates and the 10-year yield, that it would stay between 4 and 5%. And that would make interest rate sensitive investments like traded REITs and utilities, things of that nature, mostly traded REITs is what we've been talking about, that they would make it they would be appealing to a portfolio and accretive, meaning that they generate good income. And if rates stayed in that range, we could keep them in the portfolio. So I'm going to give you an update on that because there's been a mid-year revision to that. So I'm going to get you updated on that. We're going to talk about the stock market and equities. Was this thing that happened in April with the Trump tariff tantrum, was it a bull? Are we still in a bull market, or was that a bear trap? I'm going to go through an updated charts. I'm going to update you guys mid-year here about our barbell approach. How's it working? How are the stagflation names do? Are they still leading the market? So I'll update you on that. And then I'm going to give you some new information, some new opportunities that have been opening up this year, part on deregulation from the Trump administration, and others around technology, AI, quantum computing. So I'm going to share some names in those areas that we're watching, a couple things that we've added to the portfolio. And then I'm also going to give you an update on oil, energy, and the dollar, because there's been a lot of conversation recently about the dollar's demise. So I'm going to update you on the charts. I'm going to tell you what I'm expecting for the last half of the year and what I'm watching for. And I'll update you on some charts of oil and energy and how they look going into the tail end of the year. Spoiler alert, looks pretty damn good. Metals, we're going to talk about gold and silver, how they're basing, and are they ready for another move, and is that move higher or lower? And then I'm also going to talk about what's going on in palladium and uranium miners. I know uranium is not necessarily a metal, but I'm going to group it in there as, the commodities. So let's say that. So there's some big moves happening in uranium miners, palladium, gold, silver. Some of it's on the back of a weaker dollar. Some of it's just what's happening in these cycles. So today we're going to do this mid-year update so that way all the Quiver clients can get updated on what we've been doing in the portfolios the last few weeks since the last video. And for the rest of you, grab some popcorn and get ready because we're going to dig right into it. All right, let's get right into it. It is July 11th. Happy summer, everybody. I'm Colby McFadden, Quiver Financial's weekly market report. As I mentioned in the intro, we're going to skip the topics in the news and just kind of get right into the updates mid-year. Couple new things for everybody that you should know about that are on the website. We released our Q3, our third quarter newsletter, Market Minutes from the Boardroom. A lot of the charts that I'm going to go over today are in that newsletter, so I highly recommend everybody read it. All you have to do is go to the Quiver Financial website, look for the little blog tag, and click on that, and you'll find your way. We also have been putting out some information on the Genius Act and how that has the potential to be a game changer for the interest rate market and the U.S. dollar. We talk about how it's tied into trade wars with China. You really need to read it because it also ties into cryptocurrencies and what's going to be happening in the future in some of the new world of finance. It's very exciting. And to some probably very scary. So it's definitely worth a read. We'll have a lot more. We also released in our blog The Next Wave. This is a publication we talk about the future of investing, like what could be the next trend. We put a couple pieces around quantum computing. If you know anything about quantum physics, which is really hard to wrap your mind around unless you're really high, quantum computing is even harder. But nonetheless, even in today's report, I'm going to talk a little bit about a few of the companies that are leaders in there. So in the blog, we have more information. And then just to remind everybody, it's a summer schedule. I happen to live in a place that people love to come visit, and my wife has a huge family, and they're all, Midwest and other places. They love to come through California in the summer. So my house is incredibly busy, and I lose my studio when we have visitors because it's one of the extra bedrooms, right? So the summer schedule is a little spotty. I probably won't do a report next week, but the week after I will. It's been about every 2 weeks. After summer, we'll get back to the weekly program or cadence. We are going to start a new subscription page. It's not a paid subscription. This is a way, I'll show it to you later, but this is a way for me to be more compliant with the regulators. They get kind of testy when I show charts. It's a really fine line, this thing of it giving investment advice. So what I'm going to have to ask everybody who likes the videos and the podcasts and the newsletters that have the charts in it, if you like those, I'm going to have to ask you to sign up, get a password. It won't be difficult, but when you access these things, I have to make it look like I'm not talking to the general public. So you're going to see a couple things like that come out over the next month. More information to come. So let's get right into the subject matter, the mid-year update for Quiver clients. So we started the year talking about interest rates, specifically the 10-year U.S. Treasury rate. That's what they tag all interest rate conversations to. And our theme is that the 10-year yield would be stuck in a range, in a good way, a Goldilocks range that would be between, let's say, 4 and 5%. It was actually 3.75 and 4.75. And we said if we stay in that range, then interest rate sensitive investments, particularly traded REITs, would be accretive or good for a portfolio because they would generate income. And if rates could stay in that range, that you might get some share price appreciation. And that happened through April. But then when the tariff stuff happened, I've had to make a little mid-year revision because when I look at the charts, and I'm going to show you in a second, the main chart I'm going to show you, you'll probably see what I'm seeing, is things look like they want to be higher for longer in the rate world. So that's caused me to go into some of our models and reduce some of our interest rate exposure. I might be a little early, and in one particular name I was, but this is just risk mitigation. Is that my thesis in the beginning of the year is that we really would kind of hug that 4.25 line, stay on that low end of 4%, and I'll give you a picture of it here. And we did that in the first part of the year. You can kind of see through here. But what's been happening since the tariff stuff in April is we've been hugging more to this 4.5. And this chart is about 10 days old. And what's happened in the last 10 days is exactly what I talked about here. As I said, it's important in July to watch this RSI and does it bend up. And when I made this chart 11 days ago, that was a question mark. And what's happened since is the 10-year has gone from this 4.25 and it's gone up to about 4.4, and it's getting more pressure. So maybe we just stay between 4.25 and 4.5. Maybe that's we just trade sideways, which would be fine. But the fact that this is just looking more constructive to the upside, which is not great if you were investing with lower interest rates in mind. And when you see oil prices spike up, it makes you think that the next inflation numbers that we get coming through are not going to push rates lower. So I'm really concerned in the rate space. We are in the Goldilocks zone, but it feels very threatened. So I've reduced some of our exposure to things like EPR properties, which you can see here on the left. I was a little early because EPR has actually performed quite well even in the face of these higher interest rates. Over here is IYR, which is a traded REIT. It's a basket of traded REITs. So this is more like an index, you could think of it. It's a diversified portfolio. So what you should get from this is that if you're good at picking the right name, like EPR Properties, in that traded REIT space, there are a handful of names that are performing better than the basis of the group, right? So you have the overall group like this IYR that has lost momentum. Can I move my mug? Oh boy, I can't. Okay, but you can see here that after the tariff tantrum here, that we've just lost that momentum, whereas earlier in the year, we're up here in this higher range. Same thing in the mortgage REITs like Annaly Capital, AGNC. All these things have lost their momentum since April. And that's why I've revised my view on it. And that's why we reduced our exposure to these names in the models, because although they're paying great income and we still have our core holding there, it's just that they lost their upward momentum. And there's so many other things in the market that are grabbing our attention because the market has been very resilient. So this is just part of that risk management, getting a little bit ahead of the curve in interest rates. And I'll continue to monitor this. And if the 10-year, let's go back to this, if the 10-year can, stay kind of towards the bottom green line here at 4 to 4.25%, then I may come back to those names. But right now, I'm just a little anxious about the interest rate world, and just for multiple reasons. So that's what we've done. I'll update you in the next few weeks. What does it mean? Quiver clients, I'm just informing you of what we've been doing. But if you're not a Quiver client and you're somebody who's a high income seeker, or you're somebody who's more conservative, you're probably going to have more treasury bonds, REITs, more, maybe tax-free bonds. All those things are interest rate sensitive. So if you're not a Quiver client and you happen to be more conservative or more of an income seeker, this is a really important time to sit down and evaluate your portfolio for that interest rate risk and to create a plan B that, hey, if rates get to 5% or higher, then those investments are going to have a really tough time. The traded REITs, the treasury bonds, any ETFs that are around treasury bonds, any of that stuff, TLT, IEF, all these different things are going to have a difficult time if rates get up there. So if you're a conservative investor and you're not with us, if we're not managing your portfolio, this is a really good time to reach out to us, and we'll give you just a no-nonsense review and tell you, hey, here's your plan B. We'll give you plan B. You don't need to act on plan B unless the concern arises. And it's not there yet. It's just something, you want to have plan B. It's just the way to do life. So let's transition over to equities, and then we'll get into gold and silver and oil and the dollar and tie it up. So our theme when we started in 2025 on equities is that we felt the overall equity market was overvalued, that we needed to see a correction. We wanted it to be led by technology. We've gotten that. Basically, the decline in April, the things that got hit the worst were a lot of the Mag 7. In the Mag 7, the Amazons, the Googles, the Microsoft's actually done quite well. But a lot of the names in the Mag 7 are no longer moving up together. Like Apple's gone sideways. Google started to go sideways. And so out of the Mag 7, there's only been like Meta and Microsoft and NVIDIA that have continued to push higher, and everything else has kind of gone sideways. So that's what we wanted to see, because we wanted to add more tech to our portfolio. We also believed that the value sectors of the market, energy, utilities, consumer staples, would do well. And what happened in March, we made a little revision to that, because in March we started to realize that utilities and the stagflation names like consumer basics, consumer staples, that these were leading the market. They had the relative strength. So that's the market telling you that we're in stagflation. That is still continuing, and I'm going to update you on the charts. We also just recently, about a month and a half ago, made another revision to our equity 2025 themes by adding that due to the Trump administration's push on deregulation, there's going to be some great new opportunities. A lot of it in small caps, a lot of it in finance, but a lot of stuff around drones, a lot of stuff around technology. There's there's some incredible things that can happen with less regulation, and that's happening. So we've added some new names to the portfolio that are around this theme that I'll share with you. But first, let's talk about the S&P 500. So in our newsletter, Market Minutes from the Boardroom, we give you this chart, and we've been talking about this all year. That this green line that I just popped up on the screen, that basically goes right below the lows of April. Call it 5,000, 5,200 on the S&P 500. Right now, the S&P is about 6,200. So that's our bull bear line. That's basically if the market is trading above that green line, the momentum is to the upside. Max pain is to the upside. It's just the growth is there. There's no reason to get too bearish here. Okay. Now, what I just put on the screen is a dark red line that says resistance ? Well, is this going to be resistance? Because it's very normal for old highs, like this was the old high of the market back in February, that old high will be resistance. It's very rare that a market just blows through the old all-time high and just powers away. Sometimes it does, but not normally. It's got to bounce and contend with resistance and then break through. So that's what I'm watching right now, because we're right at that high end of what I think is a range. Because when I look at the relative strength and how we've rebounded out of that April low, and now it's pretty extended. I mean, when the relative strength gets up to this area, this is not where you add new exposure, okay? Because you can see anytime that you've been up in this area, shortly thereafter, you got some kind of sideways or decline movement. So just take the hint, right? So if the relative strength is up here, be patient. You don't need to chase this market right now. And because of what I'm seeing here, I've been making the call that this market looks like it's poised for this sideways kind of churn, where maybe the low end is 5,600, so we can fill this gap from one of the tariff little bumps here, and test some support down here. Maybe we only get down to 6,000, but I have a feeling that based on some of the news that's been coming out around tariffs, like the taco trade, Trump always chickens out. The taco trade is getting old. People are losing their ability to trade around Trump because it's getting old. At the end of the day, it's a little stale. So I wouldn't be too surprised that through August that we have more news around tariffs, that it causes markets just to get a little stale. And typically during the summer months, everybody, if you're in New York, if you're making money in this business and you're in New York, you're probably in the Hamptons chilling on the beach. If you're one of the senior portfolio managers, your junior guys are probably handling things right now. So usually July, August, the volume in the stock market gets pretty dried up because people are doing other things. So I wouldn't be shocked if the S&P 500 trades sideways. That's fine. We can live with that. All the sectors, all the investments that Quiver portfolios have will do just fine in sideways. Where I'll have to make an adjustment and become more aggressive in our models is if we tend to break out. So what I'm really watching for the Quiver clients right now is one of two things. Sideways, that's kind of what I'm expecting. What I want to be prepared for is stuff I don't expect. Like, what if the market turns lower very quickly? What if it springboards too much higher? So I've got game plans around both of those things. But right now, for the Quiver clients, I'm telling you, the next couple of weeks, take a vacation. There's probably not much going on here, not much to see. So if I'm a little quiet the next couple of weeks around the stock market, then that's a good thing, because this, what I'm talking about right now, is happening and we don't have any worries. What I put up here on the screen is these are the stagflation names. So if you're a Quiver client, you'll see in our portfolio that we have some utilities. That's this on the left. And then we also have some consumer basics or consumer needs. This is the stuff you have to live. These are your typical stagflation names that put in, and they've had the greatest relative strength going into April. And another reason that I think that we're in this range bound market is because what I've been noticing is when the technology or the Mag 7 names get a boost, when they get a bid and start to make a run, these stagflation sectors that were the leaders go sideways. You can see this in utilities, you can see this in consumer staples. They go sideways but not down, and then when the technology stocks lose their momentum and have a pullback, these guys springboard forward. So this barbell approach that we started earlier this year, I think we're in the third inning. If this is a 9-inning game, we're really early in this situation where you have this dichotomy between stagflation names that lead the market while tech gets a little soft, and then tech leads while these names go sideways. So that barbell approach that I've been talking about seems to make a lot of sense now that we've been in it for about 2-3 months. We need 6 to 8 months a year for this kind of trend to really make it worth our while. But it's very encouraging because both these sectors pay great dividends as well. So I told you earlier that there's some new opportunities developing around deregulation. So in the Quiver portfolios, our barbell approach has been, hey, let's anchor ourselves in some of these high yielding sectors that are more value oriented, energy, utilities, consumer staples. And then on the other side, let's go out there and buy some of the Mag 7. We've put in Amazon, Google, Microsoft. We have a ASML, which is involved in chips. So we have a handful of names that we've had in the portfolio since the start of the year. And now what we've been starting to dribble into, and this is not investment advice because there's a process of how we do this in stages. But a lot of the names you see here, like Archer Aviation, Joby Aviation, these are what they call eVTOLs, which is basically electric vehicles, electric helicopters. But it's more than that. One thing that people don't understand is that for whatever reason here in the United States, when drones started to become popular, we got more concerned about them flying around, our houses, and we put all these regulations around them. And now every other country like China and other places have all this incredible drone technology. You're seeing it in Ukraine, unfortunately, right? So it's now become a warfare item. It's aerospace and defense is what's happening in these electric helicopter companies because they're also involved in drones. They're getting government contracts. So it's interesting because they're very high risk stocks. So you'll see in our portfolios we have very teeny allocations right now because they're not making money on their own. They have revenues, but they're not at the point where you could call them a mature company. So that's why these stocks are so volatile, as you can see. But we've started to add them into the portfolio in the month of May and June, really. So hopefully these will continue to see some upside to them. But we've got them on a short leash. So the other ones to think about is around the Genius Act, which we have an article out about, and around stable coins. So the winners that look like they're benefiting the most are things like Coinbase and Robinhood. I don't think they're great businesses. However, they're in the heart of this situation. And you can see, like here with Robinhood, you can see how they've benefited. The Genius Act conversation really started coming through Congress right about here. So you can see how stuff around the Genius Act apparently has moved this. And unfortunately, my ugly mug is in the way of the Coinbase, but it looks very similar. Transitioning from that, so those are kind of the deregulation names that I'm watching, and that we're kind of dollar cost averaging into. I'm waiting on Coinbase and Robinhood. I missed the opportunity, so I like those names on a pullback. So that's something that Quiver clients should be watching as well. We have recently added into the portfolio to add a little more alpha, a little more growth potential. And again, small allocations because we're just starting, and these particular companies are very early. And what you have to remember with stocks is if a company isn't making enough money, if they're not having enough cash flow from selling their products, then what they'll do to raise capital to keep the business running is they'll do secondaries on their stock. So if you're an owner of some of these new AI companies, quantum computer companies, stuff like that, if you're going to own them, you really got to do your homework and watch their releases and their earnings reports, because the kiss of death is you could have a stock like Ionic or Rigetti that looks great today, but then tomorrow the company announces a secondary, which is basically they need to raise capital. So they sell a bunch of stock to one big institution at a little bit of a discount. And what it ends up doing, it dilutes it, and it'll prevent the stock from rising. So you could have the greatest investment thesis, but if the company has to hoard their stock out to keep revenue coming in, it can be a negative effect on the stock itself. So the quantum computing names like Ionic and Rigetti, the charts look really constructive. And so we've started some small allocations there. However, again, short leash in their holdings that I really have to pay a lot of attention to as far as their earnings and their 10Qs and the things that they release, because at any moment they could do a secondary and it changes the story. So that's just something that everybody should know, that there's many nuances to investing in a risk managed way. So these are the names that I'm watching due to deregulation, new trends in technology, stuff like that. So if you're a Quiver client and you see some of these names in there, now you know why. Okay. So let's transition there and wrap things up with the commodity sector first, starting to talk about gold and metals. Our 2025 theme was that metals would lead the markets higher and eventually move into some kind of parabolic move. That's basically been happening, as you all have heard in the news and seen, and I'm sure gotten letters in your email. Gold, silver, they're rocking here. I mean, they're the best performers of all things this year. And on the left here, you see a chart of gold, or GLD, which is an exchange traded fund that does its best to try and track the price of gold in US dollars. And then SLV is the same thing, an exchange traded fund that does its best to track the price of silver in US dollars. And you can see that they've all ran up this year. And what happens when you're in a bull market like this, when a stock or an asset runs up, it can go through a correction one of two ways. It can digest this move up, which what a correction is digesting the growth that it just had. And it can do that by either price, which means the price corrects down to some level of support, or it can do it in time. And when it does it in time, this is usually, not always, but usually what it looks like. You get this couple months of basing sideways. And then it'll contend with that resistance at the top end and eventually break through. What's happening today is that silver has broken out. Gold looks like it's getting ready to. Silver miners today, July 11th, I think are up 5 or 6%. So they've really broken out. Same with gold miners. So silver, gold. In our newsletter, we said in the beginning of July, are they basing? Question mark. It does appear they have, and they're starting the next move. For us in Quiver clients, we've been in gold and silver for a while. So as it's been rising, I've been adjusting our allocation. And this move higher, I'm probably most likely going to start to take more profits from our metals. I'm definitely not chasing this market. I'm not buying it. I'm more of a seller because I'm already in it. So Quiver clients, if you start to see confirmations that we're liquidating things like GLD or SLV, you'll know why, because we want to take our profits while we got them. We can come back to the names anytime we want. there's another reason when I get into the dollar charts of why I'm doing that. Okay, so palladium, nobody ever talks about palladium, but palladium catalytic converters and things like that. But also, palladium's a big play around Russia. When you start when Trump starts, changing his tune on Putin, you see palladium rise, right? So you can see that right here. So palladium's kind of a twofold play here. It's some geopolitical, it's some weak dollar, it's some catch up to other metals like gold and silver. But you can see in the last 2 months, palladium has had a hell of a run. So Quiver clients, I've had a few people reach out to me and say, "Hey, I see we get this little amount of palladium. Why?" Well, it's because the charts told me to do it. The charts are like a crazy person's voice. The charts made me do it. Uranium miners, which is on the right, you can see that they made a low in April and they've had a hell of a run since. There's a lot of conversation around uranium and AI. So everything about these new technologies, quantum computing, AI, whatever it may be, they take an incredible amount of energy. We don't have enough energy the way we produce it. So now uranium is becoming another subject matter. And also, what's happened is over the last 10, 15 years, the technology, nuclear technology, has improved dramatically. You'd be amazed at what they can do with something just the size of a laptop computer that has uranium in it. It's so the way of energy production and deregulation again seems to be affecting these uranium miners. So Quiver clients, if you see that we have some of that in the portfolio, it's back to that deregulation play, some geopolitical. I'd like to keep building the positions, but we'll see how they develop over time. So let's wrap it up with oil and the U.S. dollar, because that's been a big conversation. So, the U.S. and Israel went and spanked, Iran around and bunker busters. And how is it that we can drop a bomb on a nuclear facility and there's no nuclear waste coming out of it? But that's a subject matter for another day. So here we are. If anybody knows that answer, send it to me. All right. So oil's wild ride has been that when we got into the conflict with Iran, you see it spike up here. We had a big spike earlier in the year, and then it sells off after we basically annihilate them, right? And then what's happened since the start of July is oil has climbed another 4 or 5%. It's like right up in this area. So the chart, by the relative strength, it looks constructive. I don't think I'd be a buyer of oil here, but you definitely need to watch it. We have some of it in the portfolio, not a ton. Most of our exposure is more like this in XLE or Exxon and Chevron, some stocks like that. What's happened in the energy sector since I printed these charts is this has sprung board up to about 90. So the last 10, 11 days for energy and oil has seen a decent amount of growth, and which means that this relative strength is bent up right where it needed to. So the charts look really constructive in energy and in oil for the back half of the year at this moment, which we need because we've been in these energy holdings really thinking they'd be moving higher faster. They've been kind of just a sideways grind and a little bit of a disappointment. But the back half of 2025 is starting to look very beneficial. Let's put it that way. I'll update you as I see it develop. The U.S. dollar. So a lot of this stuff in commodities is happening because the dollar, as you can see, this is UUP. This is an exchange traded fund that does its best to track the price of the dollar compared to like 6 major currencies: the yen, the euro, the Australian dollar, maybe the New Zealand Kiwi or whatever they call it. So there's a few things in there. It's a decent thing to watch to kind of get an idea of what's going on. Is the dollar strengthening or weakening? You can see from the start of the year the dollar's been incredibly weak, and we're right at this point where you've got a couple levels of support. You've got horizontal support here, where we've come down into this area 1, 2, 3, now 4 times. And yes, we're breaking that support, so that's not a great sign. But I've seen these breaks before where they break and it takes a month or two, and then eventually they kind of snap back. So I'm really watching what's happening in the dollar, because it's probably very bifurcated, where either the dollar starts to get strength and that ends the rally in gold and silver. I think what could be happening is maybe the dollar is seeing its last little bit of weakness, like a spike down that's pushing a lot of commodities higher. Everybody's going to start chasing commodities because everybody likes to buy the highs, and so when everybody starts talking about how gold is great, this and that, that's probably right when the dollar makes a turn and maybe goes through 6 months to a year of strength, and then those commodity markets cool off for a while. So that's why in our gold, silver, some of these commodity holdings, I'm more apt to sell on this strength than to add to the position, because when I look at what's going on in the dollar, I wouldn't be too shocked for the next 6 months that it's stronger rather than weaker. And I don't, so the dollar's demise is highly over speculated. The Genius Act, as that comes out, that's another support to the dollar and treasuries. Read the article on our blog. You'll understand more when you do. Okay. So let's wrap it up. That was our last. In rates, prudent investors should be examining their rate exposure, because it does look like it's going to be higher for longer. Stocks, we think it's range bound. Keep that barbell approach between stagflation names, things that pay good income, higher dividend payers, and then go take a little bit of risk if you can afford to, if it fits your risk parameters, in some of the new areas of tech and some of the things around deregulation, like I shared with you. Metals, based on the dollar, based on the rate, based on just so many things, I'm planning on probably selling into strength rather than chasing it. So that's the things that I really think are the most important to update all of the Quiver clients and anybody else who's been watching the show for a while. If you're not a Quiver client and you want to know how to input some of this information into your 401k or into your investment portfolio, reach out to us. I'm happy to share information. I'm happy to share knowledge, no strings attached. For Quiver clients, I want you to have an awesome summer. You're going to be getting emails and phone calls from Justin about setting up your quarterly reviews. A lot of you are already on the calendar. So if you get an email in the next week, you don't need to respond to it if you're already on the calendar. Until next week, until 2 or 3 weeks from now, when I get my studio back from visitors, we'll do another video. And until then, have a fucking great summer. All right? All right. Take care, everybody.